Step into the Metalverse, a vast, ever-evolving realm where industrial metals take shape amidst shifting prices, market trends, and supply chain forces. But what does it all mean for you? Welcome to Cup of Joe. Named in honor of our founder, Joseph T. Ryerson, we help you navigate the Metalverse, one conversation at a time.
Welcome in, everybody, to the January 2026 episode of Cup of Joe. We're certainly glad you're with us. And I want to, my name is Mike Carrazzo, for those of you who do not know me, content manager here at Ryerson. And I want to say Happy New Year to Nick Webb, our Director of Risk Management Commodities Hedging. Happy New Year, Nick.
Happy New Year to you too, Mike. How you doing?
I'm doing well. We're in the window, my own personal window of when you can say Happy New Year. I ask people every year, like, when is the cutoff to say Happy New Year? It is the 9th. Is today the 9th? The 8th?
Today's the 8th.
Okay. I'm thinking by the 15th, you should be cut off. Other people say the entire month is fair game. Where do you stand on the Happy New Year?
On Happy New Year, I think as long as you haven't seen that person yet in the month of January, I think it's still fair game. I got the same question, though, on my Christmas tree. How long am I allowed to have that up? I feel like we're hitting the expiration date real soon on that.
Yeah, I think you should take it down and then stop saying Happy New Year. So, like, you should, yeah. So,
then I think by that logic, I think Sunday is going to be the date. So I'm gonna go through Sunday. all the bowl games, all the playoff games, and then I'll take it down on Sunday. But trying to squeeze every last ounce of life out of that thing, because we got a real tree this year, and it's really drooping down to the floor right now. So it's ready to go.
You get your money's worth.
That's right.
Although I heard if you keep it up through July, you're actually on the front end, right? You've passed the time, and you look at everybody else and say, well, what's wrong with you? How come you don't have your Christmas decorations up yet? That's a little extreme. Yeah.
Yes.
But this is great. Welcome in. This is I said last in December was our favorite episode because we look back at the predictions. This is probably second favorite episode where we make those predictions. You make those predictions. And that's what is in store today. So we have the Q&A button at the bottom. So Please send your questions along. Nick, you're going to go through 5 or 6 different predictions. We got some predictions for the show at the end.
That's right.
And we're going to have a little bit of fun. Did I miss anything?
No. So I guess the structure under which I kind of put together all the visual content is going to be, we've got 5 predictions. Within those 5 predictions, I'd probably say I have maybe 5A and 5B as well. Because I wanted to mix it up a little bit, and maybe we'll throw in a little bit of spice in here. And then, but within each one of these, I'm trying to provide sort of that same similar broader context around the macro environment. So within each one of these predictions, I'm trying to say, this is how we're viewing the macroeconomic landscape. This is how we're viewing the metals landscape, similar to what we've done in the past, but framing it all around the predictions. So that's really how it's going to sort of flow. So let's go ahead and hop into it. All right, Mike, you able to see my screen?
I am.
Excellent. I'm going to do my best not to have the technological snafus live on air that we had last month. I think we're already off to a better start, so that's wonderful news.
Last year's news.
Last year. That's last year's news. As we always have to cover the safe harbor provision. These are the opinions of Nick Webb, Mike Carrazzo. These are not the opinions of Ryerson. We are, admittedly, as the show entails, we are going to have a lot of forward-looking statements. We're even going to have, pseudo investment advice, if you will. But these are the opinions of Nick Webb, Mike Carrazzo, not the opinions of Ryerson. Do your own research. But I think we've got some great content here. Hopefully, we can have some fun with it. And because this is a slightly different structure than what we normally do, where we kind of run through a lot of similar content about inflation and jobs and things like that. If there are certain things that you think we missed and you wanted us to cover it, throw a question in at any point in time, or maybe at the end, and we can have a conversation or answer some questions around those things, whatever we may have missed. But again, we're trying to sort of center everything and all the content around these 5 predictions here that hopefully if you've got the visuals, you can see them on your screen right now. So first and foremost, this is going to be a new one, and certainly has a tinge of investment advice. My prediction for 2026 is that PAVE, which is it's an exchange traded fund, which basically means it's a basket of stocks. PAVE is an ETF that covers mostly infrastructure type names. So if it sounds a little bit like an old school economy, it should. And then the SOX is going to be the Philly Semiconductors ETF. So again, that's a basket of companies who manufacture in the public markets semiconductors, so chips, things like that. And again, if this sounds like PAVE outperforming SOX, if that sounds like old economy outperforming new economy, if that sounds something like maybe what we had touched on in 2025, it should. It has a little bit of a flavor of that. But getting into it, sort of why I landed on this one and having a similar flair as 2025. When we look back over the course of 2023 through current, we've basically seen 2+ years of not just outperformance of services, surveys and services activity relative to manufacturing. We've even seen almost a mirror image where I've drawn this white line across the middle of the screen. And as many of you may know, if you've been with us in prior Cup of Joes, these ISM surveys, if the data comes in above 50, it's suggestive of year-over-year growth. Comes in below 50, year-over-year weakness. And we really do kind of have this almost mirror-like situation where basically since the beginning of 2023, ISM manufacturing has, at least per the Institute of Supply Management survey, has trended below 50 for that entirety, with the exception of maybe 1 or 2 months. And then ISM services has been on the opposite side of that line, in growth mode on the northern side of 50. And so this has been a pretty pervasive thing for a number of years. And I will say, living in the manufacturing space, Mike, you can probably corroborate this. It's been a drudge. I mean, it's certainly been a grind for the manufacturing space in most end markets for this time duration.
Agree. Yep.
Similarly, when we look at the ETF, so this is actually peeling back the onion, looking at what the prediction is related to over this same time frame, going back to the beginning of 2023 through now. The white line, that's going to be the performance of the PAVE index. So that's the infrastructure ETF. And admittedly, its performance really hasn't been bad at all. In fact, it's been quite good. But when you compare it to the SOX index, which is the semiconductors ETF, there was a very, very brief point in time, and that brief point in time was Liberation Day in April of 2025, where the two kind of converged and their performance came together. Extremely short-lived, because since then, since April, there's been an absolute rocket ship on the semiconductor stocks, things like Micron, things like NVIDIA, things like any of the Mag 7s have certainly had some very strong performance over the last 7-8 months. And so my prediction is really kind of centered around, I think there's going to be some sort of mean reversion or a situation where PAVE starts to catch up or SOX comes down. But nonetheless, I'm basically saying that I think the nuts and bolts of the AI infrastructure is really what's going to perform, in the coming months and maybe even coming years ahead. And maybe there will be a little bit of a pullback or a relative slowdown in the semiconductors names, which have had just a phenomenal run over the last several years.
What I like about this prediction, Nick, is so last time, correct me if I'm wrong, it was like you said, an old economy versus new economy. Now you're really kind of putting some rubber to the road, so to speak, right? You're saying this particular index, which tracks those building out the physical infrastructure, will outperform the more services side of it. So you have something a little bit more tangible when we come to December to say, yes, this was clearly right or wrong.
If I learned anything in December when I was trying to judge our performance of 2025, it was that, proving accountability was a little difficult. There was always that gray area. And I feel like this takes out a lot of that gray area, because it's actually pinning us and pinning our predictions to actual indexes. And we'll be able to prove it pretty easily with just numerical figures over the course of this year. So I think you're exactly right. I'm trying to eliminate the ability for me to wiggle out of my predictions.
Well, off the cuff, I mean, what makes you feel so strong?
Yeah. So
infrastructure.
This is not without support and data and visuals. Again, these are just a couple small anecdotes. But the one glaring one is obviously just the fact that on a relative performance basis, when you think about stocks and assets in general, things typically only go up for so long before they have to take a little bit of a breather. And certainly over the last 7 months, I mean, it's a little hard to see, but I'd say it's eyeballing it. It's about 125% performance in the semiconductors index just over that 7-month time period. That is a phenomenal return on an asset class. And that's not just one stock, that is a whole basket of securities. So part of it is predicated around, at some point, what goes up, that doesn't necessarily have to come down, but it might be worth taking a little bit of a breather in this trend. The second part is really centered around these two anecdotal items. The first being about a month ago, Rivian, which is an electric vehicle manufacturer here out of Illinois, actually, they announced that they were going to start using their own in-house semiconductors, their own chips, to help them get to sort of their autonomous vehicle and their AI integration into their own vehicles. Why that's important. I think this is a very large, obviously technologically focused company in the manufacturing space that is kind of saying, you know what, if we've had all these chips issues for the last 3 or 5 years, which we noted for many months in a row, where the automotive industry was having trouble accessing chips. One way to get around that is vertically integrate into that space. And I think, we'll see whether or not Rivian's able to do it successfully or not, but just the idea that they think they can is sort of an illusion that maybe some of the chip needs that they've got, they think they can actually do in-house. There may be a little bit of a loosening up of supply demand within the automotive, space, and it's clamoring for these chips. And the second over there on the right-hand side is the fact that NVIDIA, which for the last many years was supposed to be illegal for NVIDIA to sell their own chips into China, basically to keep competition at bay a little bit. That market has effectively seemingly been open in the last several weeks, if not months. And again, I think that kind of opens up the question of, where are those chips coming from that are going to go to China if the market here was so tight that, the Googles and the Metas and, those companies were saying they couldn't get enough of them. Well, all of a sudden it looks like there is available capacity to supply not just these domestic companies, hyperscalers, but also the Chinese market. So, a couple of these kind of had me taking a step back saying, is there a point in time where maybe this tightness that we've been seeing in the chips world we may be starting to see some early solutions in those. And I think that's really part of why I think this could find a solution.
I've be forewarned. I in talking with some of our product managers, the aluminum, the stainless guys have said that the second half of the year we could see some increased demand for semiconductor. I don't know if I'm stepping on some toes later in the show, but that could derail your prediction here. So we'll see how that one goes. Yeah,
we are certainly seeing some interesting activity within the data center world. There's no doubt about that. But that being said, I think a lot of this has been built into expectations. A lot of this has been talked about. These companies, and again, that's a big part of the prediction is just that I do agree this is going to be a massive thing. But you're talking about companies like NVIDIA who have $3-4 trillion market caps, who may have been 200 or 300 million just 5 years ago. So it's more just that I think a lot of this is priced in than anything. Yeah. Mm-hmm. But in terms of detailing what's actually in each of these portfolios, just to give you a better idea of where I think I've got some optimism versus maybe where things may slightly underperform. Over on the left-hand side, you can see the category holdings of the PAVE ETF. It's things like building materials, iron and steel, which we'll obviously talk about in more detail here in a little bit, transportation, machinery. These are your older school type things. It's really the nuts and bolts, the picks and shovels. It's the grid to build out the things that are going to be necessary to get AI, which is detailed in a little more focus on the right-hand side, which is going to be your semiconductors index. You can see the familiar names like NVIDIA, Micron, AMD, which have all had phenomenal runs and are great companies. My opinion is that a lot of it's built into that world. It's less being attributed to the actual foundational aspects of that economy. So that's really what that's predicated on.
Okay, good one.
Second one is actually a bit different than what we've covered in the last couple of years, and that is housing affordability. I like the idea of housing affordability and talking about housing affordability because it covers on a couple different topics. When you think about affordability of a house, the first thing you probably want to think about is, how much does that house cost? So we'll be looking at house prices. Affordability also has to take into account incomes. How much money do you have? How much money do you make? And then it covers interest rates as well. So you get kind of a threefold that all kind of packaged together into this prediction that I think we could see 2026 be the year where we see a little bit of affordability come into the housing market. Doing a look back in time, this is a chart of the median home price going all the way back to 2000. And since 2011, I drew in this channel, this sort of upward diagonal channel. And you can see it was a pretty orderly, although inflationary, move in housing prices. So basically, as we were coming out of the financial crisis, people started to get a little bit more confident in, putting their toes back in on the housing market, and obviously some regulatory changes and things like that. It's been a pretty steady, I would say steady, but growing housing environment from a pricing standpoint. And certainly it was inflationary. We saw prices, these are in thousands of dollars. So basically went from let's say $175,000 on a median basis up to right around 2020 when the median home price was right around $300,000. Well, what happened in 2020? COVID lockdowns, COVID reopenings, helicopter money, expanding the balance sheet. There were far more buyers than sellers, and the market just went crazy. We saw it in commodities. We saw it in housing prices as well. That's really the channel that's shown on a steeper basis where, Mike, that would be where I would call things going parabolic.
Nice.
Things kind of went parabolic in the housing market from 2020 till about 2023, and that's denoted within that channel shown in the red line. Now, fast forward to where we are in the last 2-3 years. Green line again, the channel is almost parallel to where we would have been pre-COVID, but it's still on the up and up. So we are now in a situation where the median home price is in excess of $400,000. It's actually $409,000 on a median basis across the United States, which is it's a big number. It's a very big number when you consider the fact that just 10 years ago, that number was basically half of that. So, but that's only one part of the puzzle. I talked about the house price, but we need to talk about affordability. So how are we doing from an income standpoint? This is going back over the same time frame, and this is showing the median home price, but not on a notional basis. It's actually showing it on a normalized basis compared to 2000. And as you can see, house prices are up almost triple over this 25 year time frame. And how do we compare to income? Unfortunately, the white line is going to be showing us growth in incomes. And while they have grown, they have admittedly basically doubled since 2000. They have not kept pace to the extent of home prices. So what does that mean? Well, if you just think about you and I, and we're making a salary, well, what it means is if that's the only money we've got access to, a larger percentage of our income is going towards paying for the house, which is okay. That's okay. But it is tightening your access to spend on food or entertainment or, whatever your disposable income enjoyments or investments may be into, but it would be eating up a larger piece of the pie. It's just really kind of simple math, without the exception of helicopter money or taking on exceptional debt or something like that. But at some point, assuming your bills have to be paid, the income just has not kept pace with the home price increases. So you do have a little bit of a pinch there in terms of being able to pay as easily for the home prices in this environment. And then adding fuel to the fire, we have interest rates. This is the average. So this is bankrate.com. This is a 30-year average mortgage rate. And while we have come off a little bit, we've come off from 8% down to where we are right now, which is 6.2%. We just going back to 2010, we're basically 200 basis points, or that's just a fancy way of saying 2% higher than the 15-year average. So kind of adding fuel to the fire on this, on lack of affordability within the housing market isn't just the fact that the house is more expensive. It's the fact that if you have to go out and borrow a loan to pay for that house, just to service the debt on the interest is going to be more expensive as well. So it really is adding fuel to the fire in terms of inaffordability. Now, as we're on the interest rate page, I do believe that we are going to continue to see interest rates moving lower, particularly on a short-term basis. So I think the Fed, assuming we get a new Fed, which looks very, very likely come May, Trump's likely going to get quote unquote his guy. And it looks like for all intents and purposes, they have an interest in running the economy pretty hot, taking interest rates lower. I don't know for sure if that means we're going to see mortgage rates, the long end, the 30-year yield curve. I don't know if we're for sure going to see that go drastically lower. Maybe there are some things they can do where they do yield curve control and try and force long end rates lower. But for now, interest rates are pretty high relative to the recent history.
And your prediction is that housing becomes more affordable? So you said?
The prediction is that it becomes more affordable. Yeah.
Okay.
But that can mean incomes going up. That could mean
Okay.
interest rates coming down. I think most likely, and I've got a little bit of support here in a slide or two, is that I think home prices probably soften a little bit here in the coming months.
Got it. Okay.
One potential rationale for that. Well, I don't give a ton of credit to this just yet, but this is very, very fresh news. This came out in the last 2-3 days. Trump did announce that he wants to put a ban on institutional investors. So that's going to be, big money managers, hedge funds, the Blackstones of the world.
Mm-hmm.
He wants to put a ban on their ability to go out and purchase large quantities of single family homes across America. Now, I've heard some varying stats specifically on Blackstone. I think their percentage is roughly 1% of the U.S. housing market, which probably doesn't sound like a whole lot. Still probably a very big dollar amount. But Blackstone's about 1%. If you look at the overall institutional investors, I've heard the number is closer to about 3%. And then where those investments are taking place is kind of the hotter markets. I'd say places like Phoenix, places like Jacksonville, Atlanta. So I think if you go into those pocketed areas, I think the concentrations are a little higher. But nonetheless, I think the trend is still towards the favor of my prediction, which is if you take institutional money out, who's really kind of a buyer of last resort, the buyer who has all the cash in the world, they can outbid you with an all cash purchase. They don't need to take on debt to do these types of things in a lot of cases. To take that buyer out, even if it is a small sliver of the equation, it could help to bring home prices down. It could help to create a little less competitive nature when you go out to purchase home. Now, I don't know for sure if this is going to have, a sort of a landslide effect to home prices. I tend not to think so. I tend to think this is probably going to get some legal pushback as well. But this is at least fits into the prediction a little bit. Where I think the prediction is more valid is in this chart, which this is going back to 2013. And we're looking at the number of sellers in the market versus the number of buyers in the market. And this has come from MLS data, Redfin data. And a couple of things I'd point out. One is when we think back to that chart from a couple slides ago, the parabolic home price move up from 2020 to 2023. Well, what do you notice in this chart? The number of buyers that kind of came out of the woodwork and said, I'm back in the market. I'm ready to go. I'm ready to get things back to normal. The number of buyers that just burst through the seams relative to the number of sellers that were actively looking was gargantuan. And when those types of things happen, I think you get the obvious result, which is home prices go up. The sellers realize that there's tight supply and there are a ton of buyers, and prices can rip higher, and they did. Well, we're now in a situation that's really almost a mirror image of that, where a couple of things. One is we have very, very low quantities of buyers, basically the lowest going back to 2013, with only the exception of COVID lockdowns. And the other thing we have is the gap between buyers and sellers now is at an all-time record high. It's 530,000 individuals, more people looking to sell their home than there are to buy a home. And if anybody's dealt in the markets before as a broker or trader or anything like that, when you've got more sellers than buyers, usually that means you're going to see pressure on prices. Now we'll see if the sellers accept the prices at which the buyers want to buy. But what we do know is if, again, based on this chart back here, if a buyer bought their home prior to 2020, almost irrespective of the market within the United States, they're probably deeply in the money on that purchase. Meaning they've built up a lot of equity, but the flip side of that is they might have a little bit more equity to give up if they're really getting a pinch and have to sell that home. So I don't know if this is going to take place in the next 3 to 6 months, but I think certainly the trend is one that it would be somewhat healthy for that relationship of incomes to where home prices are to get back to some semblance of normalcy. And this is really what brings me back to the crux of the affordability item, which is looking at home values relative to incomes. I've often had friends and peers and family tell me, try and stay somewhere in the realm of about 3 to 3.5 times your household income to the value of your home. Now, we can deviate from that. And if people want to be, the proverbial house poor, you can certainly do so. That's not necessarily a bad thing. That just means you have a bigger interest in taking care of a more expensive home and servicing the debt on that more expensive home, but it probably means you have to sacrifice other things. That's all well and good. I certainly understand that. But when we look back over just the data and historical averages, the historical average suggests that ratio is somewhere around 3.2, 3.3. I don't think we're getting back down to that level in 2026. I think that would be a very bad thing if we got back down to that level that quickly. But could I see things get back down somewhere closer to 4% in the coming quarters? I think certainly so. And I don't think that would really be a bad thing for people to kind of tighten up a little bit, live back a little bit within their means. Because unfortunately, you can see the last time we peaked out was 2006, and what came after that would have been the financial crisis and the housing bust and things like that. I don't think any type of housing move that's that drastic and that quick is something that we want to see again in our lifetimes. But I think a little bit of conservatism in extending ourselves a little less is probably a good thing.
So one of the hotter markets in the last year was construction, right? Non-residential or residential, a little bit of residential too, right?
Yeah, but a bit of residential.
How does this impact? Do you think this has positive or negative impacts on that industry?
Yeah, I mean, I think a lot of the construction has been taking place more on the data center side, the non-res side of things. But with that being said, I mean, certainly a big theme, and it's been people have been pounding the table for this for the last 4 or 5 years, which is, we just don't have enough supply of houses to fit the amount of demand that's out there. I would, based on this chart here, I would argue that might be starting to flip a little bit, that there might be some availability come due. Maybe people who had 2 or 3 homes, maybe they're getting rid of one of those. And that can help to loosen things up a little bit. But I think if we can get more construction around the residential side of the economy, yes, it does add more supply. Yes, supply probably softens prices or at least stagnates prices a little bit. But yeah, should we see residential construction remain strong or pick up in the coming years, I think that would help to feed into this prediction, honestly.
Would it buoy things like consumer goods, manufacturing, and things to that nature, washer, dryer, fridge, other types of industries? Could we see a boon from that?
If that is to take place, I would say certainly. Yeah. Anytime you've got to pick up in remodels or pick up in new builds, certainly I think that spills into exactly what you said, the appliances, water heaters, things like that.
Okay. All right.
Yeah.
Okay.
All right. This one, I will probably call this one a layup for me, and I may be taking the easy way out on this, but higher volatility in 2026 relative to 2025. And this is a 5-year chart of the volatility index. So this is the index I'm using. And I'm actually kind of sitting here scratching my head, wondering how in the world we have a volatility index, which the volatility index, for those who don't know, is basically the market's expectation of where they think annualized volatility of basically the stock market, but of assets are going to be this year. And where we're sitting right now is an extremely low level relative to the last 5-year history. And so, this is really my starting point. And this is probably the main reason why I think it's a layup, is just I get the luxury of having my starting point be today. If I had started this up, if I was trying to make a prediction on Liberation Day back when VIX was trading above 50, I wouldn't feel so good about that prediction. But right now with VIX at 15 or right around 15, feeling pretty good that we're going to see a pickup in volatility over the course of the next several months. And I feel like you don't really have to go all that far or that far back in history to find out why I would think that. And I would be shocked if others didn't tend to have a similar thought process around this. But these are just headlines from the last week. And I'll just go through a quick bit on, I mean, we've captured the leader of Venezuela, Nicolas Maduro. We've announced just yesterday that we look to increase military spending by 50% up to $1.5 trillion. Kind of makes you wonder, is there something more behind that? Are we going to ramp up military efforts, things like that? Just a question mark. Top right corner, there are questions for Europe around how they're going to deal with NATO and the potential that Trump could take Greenland. That's kind of echoed down in the bottom left. And then, not least of which, down in the bottom right corner, just as soon as tomorrow, we are expected to get the Supreme Court's ruling on Trump's tariffs. And this is not Section 232 or 301 tariffs. This is the IEEPA tariffs, which is going to be related to fentanyl and trafficking, and also to the reciprocal tariffs. Now, the reciprocal tariffs might have less of an impact on the metals world, but they have a massive, massive impact on kind of everything else. Those reciprocal tariffs are the broad-based, 10 to 100% tariffs that were placed back on Liberation Day and kind of evolved a little bit throughout the course of the year. It's got the potential to be a pretty big headline over the weekend. So, I look at all these and I think about, where could we be going with some of these geopolitical conflicts and just the headline, volatility. I don't know how better to say it, but just the headline volatility where things are tweeted seemingly every single day that really do have market moving impacts, both on metals as well as broader asset classes in both directions. And I'm shocked that the VIX is currently trading at 15 with all that taking place very overtly in front of all of our faces.
Yeah, I mean, even the housing thing you mentioned too could create a lot of volatility in the marketplace. So,
certainly could.
So your prediction is, I'm sorry, less volatility?
The prediction more from here per the VIX, not necessarily per this screen that you're looking at right now, because it's a pretty volatile screen, but no, just using the volatility index that's currently like 15. I would say we are going to see that chop around pretty massively, mostly to the upside over the course of this year.
So if it goes to 16, you're correct.
If it only goes to 16, which I'd be happy to make that bet. And we're not bettors on Cup of Joe, but if it only went to 16 and stayed at 16 for the entire year, then maybe I should just hang out my hat and stop this podcast.
You mentioned no, come on. You mentioned there was a question earlier in the queue, and I'm sorry, it's gone all of a sudden. Technology, great, it's foiling us again. Do you anticipate there's going to be any progress in the North American trade deal this year? So specifically with regard, so not NATO, not that North American. No.
Yeah. So with regards to USMCA and our relationship with Canada and Mexico, I will say my gut feel for now is that Mexico does seem to be doing many of the things you would expect one to do, most of the things you would expect one to do when it comes to coming to the negotiating table. I would say the main thing that they're doing is putting up their own borders, their own tariffs to protect their own industry and thus the United States from dumped or underpriced goods into that country. I think that is a very big linchpin for the Trump administration to bring everybody to the table. Mm-hmm. Canada, I would say, is less so. At least my personal opinion is less so in that camp for now. And I unfortunately don't really think the Venezuela situation helps that relationship all that much. And what I mean specifically on that is I don't think this is going to be an overnight change, but from what I understand, Venezuelan crude oil is very similar in terms of its viscosity and its heaviness to Canadian crude oil. And so if the United States starts over the next 6 months, 12 months, several years, becoming more and more reliant on Venezuelan oil, which again, I think is going to take many, many billions of dollars and a whole lot of years. But if that is the general trend, that is kind of an anecdote to say they're walling off an industry of Canada, which I don't think is the right direction to show that you're coming together. I also just don't think from the Canadian side that they're doing the things that Mexico seemingly has been doing to kind of put up their own barriers. So do I think it's likely? I could see, and I've had this conversation with some internal people here at Ryerson. It wouldn't shock me if we kind of split the two apart and do negotiations, not as a whole tri-party agreement, but as an individual relationship with both nations.
Because that's going to have a huge impact on volatility, I would imagine.
I would think so.
Yeah. Okay.
Yeah. All right. Getting into number 4, and then this is sort of where we get some 4A, 4B, some additional predictions woven within. I didn't want to just stick to 5. That's too few. But my prediction is that even though we did see steel imports drop in 2025, my prediction is that we're going to see them further decline in 2026 across steel products. And there are really two main reasons. The first of which is that we are actually seeing new investments, new ramp ups in production capacity in the United States. And I'm not going to go through all of these, but over there on the left-hand side, via POSCO and their investment into U.S. Steel, there are a number of improvements, expansions, all sorts of upgrades that are taking place across the U.S. steel footprint. And again, I'm not going to run through all of those, but there's a lot going on, and it's tied to many billions of dollars. It's, between 10 and 15 billion that's looking to be invested. So that'll be a very interesting thing to see play out. And then over on the right-hand side, you've got Nucor, which has got their West Virginia facility coming up over the course of this year. Steel Dynamics with Sinton that we've detailed on Cup of Joe. And then Hyundai Steel down in Louisiana, $6 billion greenfield project. That one's probably going to be a little longer term, maybe starts later, like late in the year, and maybe more of a 2027 story. But the theme of this is ultimately just to say, if you've got more domestic production coming online, your reliance on foreign metal should be less. There should just be, shorter supply chains, hopefully better customer service, things like that will allow people to focus more in-house, in-country, and rely a little less on foreign product. I didn't have this in a slide, but I think secondarily, the fact that Algoma has effectively pulled out of the United States market, that one's kind of a gimme that says that imports are going to continue to decline year over year, because if they don't, unless pricing goes up to like $1,100, $1,200 on hot roll, I don't think Algoma is going to be playing in the United States in a big way in 2026 relative to last year. So I think that one's an inherent, maybe obvious piece of the puzzle. But then the other one is just, with 50% tariffs, and these obviously went into effect earlier this year at a 50% rate on everybody, but we're going to get a full year of 50% tariffs on pretty much every region of the world. And what that means is the U.S. pricing has a moat. And whether that means 950 or 1,000 is kind of that break even for imports to maybe consider coming. It's at least going to allow domestic mills to kind of play with things to say, if they start to get a hint that imports are starting to flow in, well, then just drop your price a little bit lower, take them down to 950, 925, 900. All of a sudden, imports don't look attractive again. So there is a real buffering impact that's going to benefit the supply side of the equation in the carbon space. So it's really the twofold equation of there's going to be a lot more domestic supply coming online. So that's going to give people more options, shorter lead times. I think that's going to wall off some of the imports. And the second factor is just the tariff is meaningful. When you look at European steel prices shown in the blue line, those are US dollars per short ton on an ex works basis. So toss $100 on it, on that price to get it to the United States, put you at, let's say, $750. You toss 50% on top of that gives you kind of a break-even price of $1,050 to $1,100. That's we're not there right now. So for now, carbon prices are not really inviting in a wave of foreign product. There might be bits of some players who are like, we'll take smaller margins and we'll continue to sell in the United States just so we have a little bit of a toe in the water. But I think this moat's going to be real, and I think it's going to allow the range of prices for steel producers to sell at to be a little higher than what we've traditionally seen in the past.
That being said, isn't capacity utilization at a pretty low point right now domestically?
It is. It's been around 75% for a number of months now. So the U.S. mills are keeping things pretty subdued. And the unfortunate side of that is I think that probably means that demand hasn't yet really come on in a big way.
Yeah.
Maybe the way we would have wanted it to. That said, we are hearing some anecdotes that the auto industry is really pinching things a little, that they're kind of scrambling for tons over the January, February timeframe. So that's one pocket of what I would call relative strength. But yeah, on the whole, just given the fact that these mills that are in existence in the United States, they're running at 75% capacity, that kind of tells you the demand picture is still tepid. But we are seeing price inflation regardless. And again, I think that comes back to the buffer of tariffs.
And you're considering more capacity coming online, as you said in the earlier slide too, and kind of subdued demand. If demand does pick back up, then you can ramp up production in these mills that are a little bit softer, and that would keep imports out. I have that right?
Yeah, that's right. That's right.
Okay.
Yeah. And so this is the chart kind of depicting what that prediction would look like. Obviously, over the last 12 months, we did see steel imports decline. I think that we're probably going to see that trend continue. So this is really the barometer. This Department of Commerce website tracker is what we're going to use to keep accountability around Cup of Joe.
Yeah.
But feeding into the carbon story, want to give a little bit more color around what we're seeing within that space. So I really like this chart. This is a 3-year seasonality chart. So I probably got to detail what this is. Left-hand side is going to be January, start of the year. Right-hand side is going to be December. And each of these lines, so the pink is going to be 2023, the gold color is going to be 2024, and the green is going to be 2025. And the white is going to be the average of the last 3 years. And you can see that what we've tended to see on an average basis, if we just look at the white line, is that prices have tended to, over the last 3 years, move up on a cyclical basis up through, say, a March, April timeframe, sort of peak out. And then they get to a level where, for whatever reason, whether it's imports arriving in the United States, whether it's, they just push things too far and you get a buyer strike, whatever the cause of that, and it's probably different each year, you then see a little bit of a summer degradation. You get some plant shutdowns around the holidays of 4th of July, and then you trough out somewhere in the October, maybe late October timeframe. And then you start to kind of get back into the cycle again, where you have year-end buys, and people try and prep for what tends to be a more seasonally strong time for manufacturing, which is Q1 through April, I would say. The reason why I pull this up is, and this is sort of prediction 4B, which is I tend to think we're going to see something like this chart again, where it does feel like prices have a bit of momentum right now. It does feel like we're probably going to see something in the realm of $950 to $1,000 on hot roll, and whatever that means for cold rolled and galv, based on normal spreads. But it does feel like there is some tightness in the market. There was a crane incident at Butler, which is a Steel Dynamics facility, Butler, where they had they've got a temporary outage. So that's further feeding the tightness on the supply side, in addition to those utilization numbers you referenced, Mike. So, combining that with the fact that this tends to be kind of the strong point for manufacturing over the next several months, it does look like the market's pretty tight. But again, I think my prediction is I think we probably see a little bit of that seasonal fade that we've seen over the last 3 years as we roll beyond that point in time. Because if nothing else, one is at some point in time, you can take prices so high that at some point people go out and say, okay, maybe I should buy a little bit of import on a cheaper basis, and they'll just go out and take a stab at some of that import. But I think the other factor is, with all of this newly announced production that's ramping up over the course of this year, the markets are going to be pretty well supplied with I guess, unless we do have a real demand rally where we have robust demand strength. And I given the fact that I just don't see that yet, I think this prediction of sort of an upcycle for the next 3-4 months, maybe 5 months, and then a bit of a fade as we get more and more supply coming online to meet those higher prices. I think we start to see those new mills kind of try and compete for tons. And I think at that point in time, you start to see prices fade a little bit. I don't think the trough is going to be crazy low, but I don't think $950 to $1,000 is really sustainable with that many new tons coming online over the course of the year.
Well, we're kind of at that point already, right? 930 on the CRU, 950, I think, is Nucor's. Is that right at this point?
Yeah, you're not wrong. It is almost as if we are doing the cycle a little early this time. Yeah. So yeah, I think a lot of that's going to depend on, one, how long this Butler outage lasts. Two, how strong is automotive, in fact, for the next couple of months. If demand isn't showing some signs of life, then yeah, this could play out a little quicker than what the white line would depict. Because yeah, you're right. Over there on the left-hand side, you can barely see it, but just the January couple days worth of data showing kind of mid-900s where we already are. But it still feels like it's got a little momentum to the upside for now. But yeah, again, without that being met with a bit of a demand increase, a bit of optimism, then yeah, it could fade sooner than what we've seen in prior years.
Question here from the audience: do you think the fade in prices lands us higher lows, floor for pricing?
Yeah, I think the floor to which we go ultimately is going to be higher. I think you've got players like Algoma out of the market, seemingly, who could have been like those bottom feeders that they wanted to participate at any cost. I think given the fact that you've got the 50% tariff out there, assuming that remains in place, yeah, I absolutely think that lifts the floor to which prices ultimately go. So I something with like a 6 handle doesn't really seem like it would make any sense, particularly given the fact that, even Chinese prices have a mid 4 handle on them. Yeah, I just don't see that playing out unless we got something really ugly in the macroeconomy.
Well, that leads to another question from the audience member. I hope you don't mind. Do you expect more U.S. companies operating in Canada to shift their commitments from Canada to the United States?
It's an interesting one. I've seen different sides of this coin. I've seen some companies within the like ISM surveys. I've seen some companies saying that they're actually moving manufacturing out of the United States because they don't want to have to deal with the tariff regime, which kind of goes very, very against sort of the question that we just got. I'm sort of taking a political answer here, but I think it's going to depend on everybody's supply chain on where they ultimately sell their end product. If they're keeping everything domestic and they've got a mandate to buy local, I think those things probably are shifting into the United States a little bit. To the extent that end products aren't required to be U.S. made, there might be investments made outside the United States and kept outside the United States, which that wouldn't be a great thing for the U.S. in this current tariff regime.
Yeah. And to one more here, to Kim, who's asking us if seasonality goes for aluminum as well. Hold tight for about 3 minutes if you could. We'll get to that.
Yeah, hold tight. I mean, in terms of the seasonality, I haven't seen it hold as true for steel. I don't know why exactly there tends to be buying patterns within steel that don't exist in other markets. And I don't exactly know why this is like a November timeframe. It seems like everybody and their brothers talking about that year-end buy. And yet we don't as often look at those types of things in aluminum or in stainless. Maybe we do in small amounts, but it almost feels like carbon tends to be way more like big money in, big money out, big money in, big money out. And it creates bigger gyrations that tend to be meaningful in price, but temporary in time, if that makes sense. Sure. And you can kind of see it here within this chart. I mean, it just looks like a roller coaster ride every single year. And most other base metals don't tend to function that way, from what I can tell.
Yeah, he'll get to aluminum here shortly, so hold tight.
Absolutely. and last but not least, on the steel side,
hey, there it is. That's the first one.
There it is.
First one of 2026.
Unbelievable. It took me that long.
We're nowhere close to being last but not least. There you go.
It took me 45 minutes to get to the last but not least. This is the steel futures curve, which is, if it looks similar to what the historical trajectory of the 3-year average looks like, perhaps it's that's perhaps the futures market and those trading in futures are watching similar things that I'm looking at. But I think the futures market's basically saying the same thing that I just said, which is there is expected to be a new wave of domestic supply. At some point, prices go too high. You do get a little bit of a buyer strike, and at some point, things fade a little bit. Futures numbers are never accurate, but the directions kind of tend to be at times. So don't hold my feet to the fire and say that this is for sure how it's going to play out. But something directionally feels like this is probably what's going to repeat this year, barring massive recession or a massive rejuvenation in end demand, which at this point in time, I would say we are not seeing either one of those just yet. All right. I'm not saying last but not least, but my fifth and final prediction is that I think Midwest premium prices, which would be denoted by this blue line here, and I don't know if this is an easy call or a tough call. I'm kind of worried about this one, actually. My prediction is that Midwest aluminum prices, as of today, going forward throughout the course of the year, are going to be lower by the end of the year versus where we are right now. Now, this is just a crazy chart because this is going back to those times where we had all-time record highs in carbon prices, in steel prices, in aluminum prices, in copper prices. And I didn't think we would get back up there so quickly within Midwest transaction, but with the 50% tariff, we got back there and then some. We've cut through the all-time highs, which were set back in March 2022, like butter, and we are now trading at $2.35 a pound on Midwest transactions, which is the summation of the London Metal Exchange price shown in white with the Midwest premium, which is the logistics and the tariffs needed to get aluminum ingot to the Midwestern portion of the United States. Now, my math and the analysis I look at kind of does suggest that from a fundamental basis, we may have overshot a little bit. And I also think we've probably overshot a little bit so far that imports are now looking a little more attractive, even with a 50% tariff, that at some point prices can only go so high before domestic purchasers say, fine, I'll go out and keep buying from a foreign player. I'll pay the tariff and I'll just go that route. Even if it's got a longer lead time, if it saves me 20 cents a pound or 10%, I'm going to do it. that those things don't flip on a dime immediately. They take time to have the lead times, get the product here. But that's really what this prediction is predicated on. Just that there's the saying out there, the cure for high prices is high prices. And I think at some point you get prices going so high that you get a buyer strike, you get people looking at foreign product that's currently cheaper. And Harbor, which is a subscription service that covers predominantly aluminum, they kind of echo this sentiment, which is the import window is the largest it's ever been. And that, if that sounds crazy, given the fact that we have 50% tariffs, it maybe should, because what happens if that 50% tariff is to drop to 25% or drop to 0% to Canada, which those odds are probably decreasing right now versus where my head would have been 6 months ago. But if there is something that, tariffs are ruled illegal, or the USMCA, we actually come to an agreement over the course of this year, that import gap doesn't just open, it becomes massive. And because even with the tariffs, it's already open right now. So again, my prediction is really predicated on the fact that I think at some point you hit a certain price level where either buyers get too frustrated, too upset, and they just kind of go quiet for a little bit, or they go out and they find other sources and just pay the tariff.
Yeah, because correct me if I'm wrong, premiums are what, 95 cents, 93 cents? Is that,
as of today, we are at 98 cents, which
98
I would have never guessed we would have gotten at this point. Now, part of that is going to be predicated on the fact that LME has in fact risen. So if you look at the LME price 2 months ago, we were down at $1.20. We're now at $1.40. That 20 cents, it becomes multiplicative to the premium, because if not only does your LME price go up by 20 cents, the tariff on that extra 20 cents has now gone up by 10 cents, if that makes sense. The quick math on that is just 20-cent increase times 50% tariff gives you an extra 10 cents for anybody buying aluminum in the United States. So these tariffs are, as LME rises, they kind of compound on one another. And that's, you can see it over on the top right-hand side. That chart is going parabolic. It's almost straight up and down. And, typically charts don't just end and then stay at that type of level. You look back to 2022, we went parabolic for a short period of time, and then it goes parabolic the opposite way. And unfortunately, that's usually how markets work. And being in the aluminum world, I hope that it doesn't work that way, but knowing markets and knowing charts well enough that they tend not to just go straight up forever and then nobody cares about anything. They usually tend to reverse course at some point in time. We just don't know exactly when that is. And momentum, as I was discussing with a colleague of mine, momentum can be a very powerful and difficult thing to time.
We got a few people asking about capacity here, right, in aluminum, right? And from what I understand, even depots and brokers are kind of low on inventory. I guess why are we not seeing more in the face of all this?
Yeah, I think part of it is going to be, some of the traders who bring product into the United States, I think they're a little scared of the tariff risk, that the potential that, if they have something in transit coming to the United States, they're a little worried that if those tariffs are to get rescinded or brought down, that they're kind of caught holding the bag. So they're more agnostic or more disinterested in bringing product overseas without some type of firm contract. But I think the other thing is, if traders are moving product more towards the United States, which they kind of mentioned in this article, I didn't highlight the part that I wanted to say, but Harbor, in this same write-up, they basically said the U.S. is the most attractive market for aluminum in the entire world right now. And so if that's the case, it should just be a matter of time before traders say, let's get a barge, let's get some insurance contracts, let's start shipping product there. But that doesn't happen overnight. That's going to take a couple months. So if depots are lean and they're kind of stocked out, and if we have a situation like this, which is the Oswego facility, which is still down and expected to be down for several more months, the expectation around this fire is that they're going to have to spend about $225 million to rejuvenate their facility. This is one more thing that's kind of keeping the market artificially tight. I can't say artificially because it is real, but it is sort of that headline grabber that's keeping the market a bit spooked for the time being. I like to think clearer heads prevail 3-4 months down the road. Supply conditions start to balance out a little bit, but yeah, I mean, it's a tight market, but so are prices. I mean, prices are at record highs by 10% now. So
Yeah, wild. Just a wild start to the year for aluminum.
it is a wild start to the year. I mean, this is the fire, Mike, that you and I talked about probably about a month and a half ago. And it was like, oh, it's no big deal. They've already got it put out. No harm, no foul. Turns out that's the one that's actually causing these bigger issues, it sounds like.
Yeah. Yeah.
So it's just one thing after another within aluminum. I just wanted, this is a quick aside, but some of our customers, some of our colleagues like to see bank forecasts. This is just on the London Metal Exchange price. So this is not the Midwest Premium, but looking at where current median and mean, so mean is just the average prices versus where we are right now. The current spot price is right around $1.40. When we look at the mean and median forecasts, basically they're closer to about $1.30, $1.35. So most of the analysts are kind of saying we've already overshot their forecasts for the year. So, that doesn't necessarily mean we have to go down. These analysts can certainly be wrong. They could have missed something. Maybe they didn't account for the fact that there'd be a fire, or maybe they had different assumptions about tariffs. But on the whole, I think it's 19 analysts since December. Their updated forecasts have us a little lower than where we are right now, to the tune of 5 to 10 cents, depending on which analyst it is.
Yeah.
The other thing that's supporting aluminum, and this one's maybe more theoretical than it is reality, but I would actually love to make a call out to any of our colleagues or any of our customers if they have thoughts on this. There is within the trading community, so within like the hedge fund community and those who are trading these commodities day in, day out, minute by minute, there's a theory within the trading community that at some point in time, if copper goes so high and the relationship of copper to aluminum goes above 4 times, meaning the price of copper is more than 4 times that of aluminum. And you'll see that historical relationship depicted down here in this chart on the bottom left. When that gets above four times, the argument is those who bought copper will then switch to aluminum. So the argument basically says at some point there should be a substitutive effect of those who buy copper eventually saying, price has gone too far, too fast. We're going to start swapping in aluminum. I would love to know from any of our customers if that actually happens in short-term practice, that if it's that easy to just say, okay, we flipped the switch, we've gone above 4 times, let's start buying aluminum. I know within the trading community, those who are trading financial contracts and things like that, they like to look at this, and they are currently viewing that as a bullish reason to get longer on aluminum. And as we stand right now, the relationship is at 4.11 times. So we are in that world where the trading community would say you should switch. But I would love to know fundamentally, if you're running a manufacturing facility, can it be that easy? Can you do that in a couple of months? Can you do that in 6 months? Can you switch from copper to aluminum? And if so, is that just a giant pain in the butt? How does that work? So message out to all of our listeners. Love to hear back some feedback, and obviously you can reach out to the Cup of Joe team on that. All right. Moving on to nickel prices, so I'm going to make a quick aside here. I know we're getting a little close on the hour, but this is the tricky part. I'm trying to give myself a little bit of mental support. The tricky part about doing these predictions is that you don't really know what the starting point is, and you don't really know what the end point of when we're going to call, were we right or were we wrong on these types of things? Because if we went back to, let's say, early December, which is when, Mike, you and I had our discussion of whether or not I was correct. Because at the beginning of 2025, I said, I believe that nickel prices are going to finally trough in 2025, and they are going to begin to move higher. Well, if we had just taken a snapshot as of beginning of December, didn't look all that great. It didn't look that bad, but it didn't look that great. I think on the average was actually slightly up on the year versus where we started. So there were some caveats in there. I was trying to give myself the benefit of the doubt, but admittedly, I mean, the price was still well below $7 a pound at that time. And I would say, at least in part, I was wrong on that call of nickel prices really moving higher. Well, if we had taken that same snapshot as of the last business day of the year, we would have been up above $7.50 a pound. And I would have been a hero. I would have been a resounding favorite amongst the prediction community.
Oh my God. Yeah. It's funny. Yeah. They all slammed in right in the last day of the year after we said we were wrong.
Yeah. So
Just to
so
prove you right.
So this is a 1-year chart of LME nickel prices, US dollars per pound, and essentially mid-December, it came out that Indonesia was beginning to look at their production levels and that they might start to do some things to rationalize and curtail some production for 2026. Well, right off the bat, without even seeing any real production numbers, without even hearing any real numbers around what they were going to cut, the market went gangbusters, and you can see it very clearly in this chart. So from the middle of December to 2 days ago, the price of nickel went up 30% in 3 weeks. 30%. Giant move. Absolutely massive move. For what was probably the most hated, and maybe still is the most hated of all of the base metals we look at. Stainless steel markets are still very loose. I wouldn't say a whole lot's changed on the fundamental supply-demand side there. So what in the world gives? Why in the world did the nickel price jump 30% in 3 weeks? Well, the first thing that I already mentioned was the fact that Indonesia and their mining ministry is looking as if they're going to start rationing and cutting how much individual companies can produce over the course of 2026. Certainly saying the right thing. We have not yet seen the numbers of how much they are going to cut or how much they're going to mandate. How strong are those mandates going to be? I tend to be, I tend to think this is a little bit of a show me story. I want to see it show up in production numbers, export numbers, inventory numbers, and we just don't see that yet. But they're at least saying the right thing, and sometimes saying the right thing can give the market a little bit of optimism. And so I'll move on to the next slide. When we just look at inventory levels, so this is the London Metal Exchange inventory levels. It's not syncing up at all with what the narrative is from Indonesia, which is that they're cutting production. The story on the London Metal Exchange, in essence, says the opposite, which is that more supplies and even faster supplies are coming at least onto the exchange system, which the London Metal Exchange is not the only place where you can put nickel, but it is a place, and it is a visible place where you can put nickel. And it's not going down. It's still certainly going up. So this doesn't really fit the story just yet. It's not to say that it can at some point. I do, because I'm a cynic, I do wonder if there's a little bit of gamesmanship being had here. And why do I think that? Why do I think there's a possibility of that? Well, if you take nickel, and this is from S&P Global, if you take nickel prices down around $6 a pound, and you draw a straight line across from $6 a pound, these are over here to the left-hand side. Those are all the producers who can still make money mining nickel at roughly $6 a pound. Everybody over here is unprofitable at anything below $6.25 a pound, let's say. Where nickel prices went over the last 3 weeks took us all the way up to this green line. And what do you know? Over here on the right-hand side, all of a sudden, all these producers, basically every producer in the world except for one, at mid $8 nickel is then profitable. Well, that's wonderful. And granted, this chart shows that it's kind of short-lived because we're already seeing a pretty large pullback. But what if, and I'm being cynical right now, but what if Indonesia kind of floated that headline out there? They said, we're going to cut production, and prices rip, they jump 30%. And what if all those Indonesia miners immediately sold futures contracts? They basically short the market to lock in their gains. I wouldn't put it past the industry to do something like that, because all of a sudden, any of these producers who are over here on the right-hand side who are sucking wind, terrified for their lives, terrified to keep operating as a going concern business, all of a sudden they just got a lifeblood. They just got a lifesaver. They can go out and they can lock in futures and ensure that at least for the next 12, 24 months into the future, they can guarantee that their price is locked in, under where they sell their metal for that time frame. I don't know if that's what happened. It's just a possibility. But I mean, it is staggering to see when you look at all these producers who were and probably still are a bit scared about where prices went. All of a sudden, that price move gives a lot of new life to a lot of new producers. So my 5B prediction is because of this chart, because of the way the dynamics of this chart work, I tend to think we shouldn't probably see nickel prices go too much higher from here. I tend to think we're going to be in a range. And maybe this shouldn't even be any real secret, because Indonesia has been pretty overt about the way they wanted to manage the nickel market. They've basically said they want to manage it between $15,000 a metric ton and $18,000 a metric ton. At $15,000, they kind of get spooked. People aren't making money. That's when they maybe float those headlines and they start, cutting people's production availability. If we get up to 18,000, which is we're around where we were, maybe they say, okay, we're making a lot of money. Let's let our miners cook and let's bring in the profits. If we are to go above $10 a pound, there's really no producer in the world who can't make money at that type of level. And I think when you combine current pricing in the 750 to 850 range with the fact that, as I said, the stainless market's still not great. It's still pretty soft. I would say it's probably the softest of any of the industrial spaces we look into. Until that improves, the world doesn't need a whole lot more stainless. The world doesn't need a whole lot more nickel. It'd be nice if we could see better balances in these things. And I think we're seeing the signs of those things coming from Indonesia, but I don't think there's any real fundamental reason why we see prices go substantially above $8.59 a pound for 2026. So again, the prediction for nickel is basically, a range bound type market.
And of course, this all floats into the stainless surcharge, nickel making up a big portion of that, right? So
that's a great point. That's a great point
for February. February's already higher, isn't it?
Yeah, that's a great point. And thank you for bringing that up. Yeah. To put this into what's this mean for boots on the ground, 300 level stainless as an approximation, we're probably going to see February surcharges settle about 8 to 10 cents higher across 300 series. If nickel remains up around 750, a small increase more for March. So not massive increases, but certainly a new thing for the stainless market, which we have not seen for 3 years, which is a move higher in surcharges.
Yeah.
And I believe this is last but not least. If we went back to 2022 when nickel prices went to record highs and we had the massive short squeeze and we had the London Metal Exchange losing $20 billion, just pure chaos. All of that was caused by what's called a short squeeze or short covering. They're basically the same thing. What we're looking at in this chart is the number of asset managers or investment companies who were short nickel. And so anything positive, as the number gets bigger and bigger, that is the number of trading companies who are expecting the price of nickel to go down. They're betting money that the price is going to go down. What happens when it doesn't go down? Those people who are short, they essentially have unlimited risk to the upside. So as prices start to move higher and higher and higher, any of these investment funds, they start to get very, very spooked because the upside, it can go to $1 million. And as we saw a couple of years ago, it did go kind of to infinity, and it caused massive billions of losses. Well, I do think that in the last 3 weeks, we saw a very small version of that, because what this is again showing is the number of short contracts for investment managers. And since mid-December, we've gone from 50,000 contracts, and one contract is 5 metric tons. And it's slammed all the way down to the market is still net short, but they're only short 30,000 contracts now. So 20,000 contracts or 100,000 metric tons of short positions basically got liquidated because those who were short kind of panicked and they had to cover their positions. And when they cover their positions, that can exacerbate the moves in price to the upside, because in order to get out of a short position, the only way to get out of it is to buy those contracts back. So you're kind of fueling the fire to the upside. It happened in 2022. I would argue we probably saw a small version of that in the last couple of weeks as well. So some of this is fundamental. Some of this is, mechanics of the market, mechanics of short selling and things like that. But thought that was kind of interesting as well.
Yeah.
All right. So with all that, unless there are other questions, we'll leave it with this, which was a month ago, Mike and I talked about our wish list for 2026. We talked about the fact that within manufacturing, we'd love to see, and we often get questions from our investors, what's a good market for manufacturing look like? And that's something like a PMI that's in the 52 to 54 range, and to get it for at least a couple months in duration consecutively. We aren't there yet, but we're hoping that it comes. We're just reminding you of these ones in blue. Steel, we are seeing the price move to the upside, and we are hearing about automotive being pretty strong in January, February. It's not broad-based across all end markets, but we'd love to see a little bit of a demand pickup. And without a flood of imports, again, that's one of my predictions, that I don't think we'll see the flood of imports because we'll have so much new domestic supply coming online. Aluminum, new domestic tons coming online faster in 2026. No fires.
Okay.
Well, the no fires, unfortunately, that's not helping. It's not playing out as we had hoped. That we were hoping that was going to be very short lived. It looks like it's going to be at least several months for the Oswego facility. New domestic tons. I don't think there are going to be any new domestic smelted tons, though we are going to have some new domestic supply coming by way of Aluminum Dynamics. All right, this is where we got to get serious. The Bears got a Super Bowl. Hope that starts this weekend against the Packers. Mike, you got any thoughts on that?
No, I just still recovering from the last Bears Packers game. So they're playing the Packers this Saturday. Wild card. I'm afraid to make any predictions on this one because we did the Cubs bet with your analyst Joey. I lost that one. As you see, scratched out below there's the Buckeyes national championship. So, hey, I think they can at least make it past this weekend. I'm gonna go. They make it to the NFC Championship game. They lose in the NFC Championship game.
Hey, I call that a successful year.
Yes. And if they lose this weekend, it's not as successful because they've lost to the Packers, which is always bad here in Chicago.
That's right. Yeah. And just as a quick aside, I made that picture over on the right-hand side last month before we knew what was going to transpire. And my artificial intelligence machine that made the image, it put an Ohio State Buckeyes helmet with the head. It's still inside of it. It put it on top of a trophy. It was kind of morbid at the time, but I thought it was funny. And I think AI kind of read the future because that's kind of what happened.
Yeah, I think so. Yeah, you put a stake in the Buckeyes before that, or at least that Bears character did. So
the Nick Webb. But with that said, I want to transition to the more important ones, which is your predictions for 2026.
Yeah, before I jump in, we got Jenny probably from Denver saying go Broncos, and you got a Bears hater here saying have the Bears existed after 1985? No, we have not, and we'll continue to do that until we win again. Yeah, for these, I tried to look at some of the predictions for the show. We did something fun at the end of the year where, with the help of AI, we combed through all the transcriptions, and we actually said that there was over 130,000 words spoken in Cup of Joe over the last year. A majority of those.
I blabber way too much.
Yeah, that's but what was really cool is over 600 questions. Now that's questions from me, questions from guests, questions from viewers, which is really good, right? So maybe the viewer questions kind of settled maybe around 300, 400 or so, which is outstanding because that's what we want this to be. We want this to be a very conversational community where you can ask the questions that you need to get answered. And I think one of my I'm jumping to that third one there. We get about, I want to say 300 live, and then we get a bunch more watching on YouTube and the podcast. But I think in this year, I think we're going to see even more active participants. So we're already seeing it today. Some very, very good questions. Actually, there's a lot of questions in here that we can't get to, but we will follow up with you. There's a few requests for some charts as well, Nick, so I'll follow up with you there. Okay. Right. I'm really pleased that this has become a community. This has become a spot where, Nick, you're sharing your insights. The community comes here to kind of get their questions answered. So I think that's going to continue.
Yeah, and I'll go even one step further to say, not just a hope or a prediction. I would say it's a request from me, which is hopefully any of our listeners get the sense that we do like to have fun with this, but we do also like to disseminate the information very seriously and accurately. But again, we like to have fun with this. So if you've got thoughts, questions, anything that's on your mind, even if you think it doesn't even relate to metals markets, we want to hear about it. We'd love to have the chats. Because Mike and I have a good time doing this. And it's more fun when we got your participation.
Absolutely. Yeah. And we answer questions outside the show, right? If we can't get to them, Nick's great to follow up, and so is everybody else. We pass it on to the product managers and so on and so forth. But yeah, I agree. It's an encouragement. And then based on that last year with how many things were mentioned, carbon was obviously mentioned the most, but I think steel is going to continue to anchor the conversation. But I think we're going to get the most questions around aluminum. And if the first few weeks of 2026 have shown anything, I think that's going to be true. So those are my two. They're a little squishy, so I'll put a little bit more meat to them so you can actually hold my feet to the fire by next year. But I think that's it for us. We ran really over, but I think in a good way because there was a lot of good conversation here. The last thing I do want to mention, next month we have an extended version. We're going to be on for 90 minutes, although we're almost on for 90 minutes today. So, but keep with us next week. We have 3 product managers with us as well, one from stainless, one from carbon, one from aluminum, as well as Nick and myself. And it should be a great time. And Nick, any closing thoughts for us?
No, I mean, nothing really except for reiterating the fact that it looks like it's going to be a volatile one, headline oriented and metals oriented. And, we don't necessarily love the volatility within our industry and within our conversations, but we do love disseminating it out to you, hopefully in a fun and accurate way. And so we really look forward to doing it here again in 2026. And obviously we just made it through the holidays, but still a happy, healthy, fruitful 2026 to everyone. Let's get after it.
Echo that. See ya. Thanks, everybody. Appreciate it.
Thanks.